Hi guys, welcome to my channel. I am going to share to you about mortgage and also housing. In Singapore, as we all know, mortgage housing it's something that's very expensive here in Singapore. It has grown in terms of prices a lot over the decades. Uh, Back then in the 70s and 80s, housing was perhaps more affordable if you convert it to this money. We started off HDB with just like $20,000, and in the 80s it was like from $50,000 all the way up to about $80,000 for a HDB 4-room flat. Today, in 2021, HDB 4-room flat goes for like how much?
About $300,000, $400,000, $500,000 and above.
Even in different locations in Singapore. So it's for young couples or for those who are new into buying BTOs in Singapore. It's quite a big commitment, especially for young couples like yourself. For those of you who are applying for an EC or even a private condominium, that uh, that commitment is of course higher, and it takes a lot of your finances as you are starting out with your life. So because in Singapore it has become like a rite of passage for the young or for people who are going to settle down to actually buy a home for themselves. As we all know that home ownership is one of the our home ownership here in Singapore is one of the highest in the world. So so technically we are more buyers and owners of property rather than renters, although it's kind of okay. So mortgage and housing. So how much of our pay is going towards mortgage? Is it a lot? How much is allowed? um, are we spending too much on our property? Are we overextending ourselves? uh, do we take our parents as benchmark, or do we take our friends as benchmark? Is that the right way to handle our finances? Can we afford to buy that 4-room flat? Can we afford to buy that condominium at this or at this stage of our lives? Things that you should, before you even engage into buying a property, and also things that you should know before even signing on the dotted line. So first of all, uh, most of us here in Singapore are using our CPF to purchase our house. Uh, Unlike those who are self-employed right from the start, um, or in other countries people are using cash to buy their homes. But in Singapore, quite uniquely Singapore, we can use a portion of our retirement money, which is the CPF, uh, to purchase a house. Is that a good thing? Only time will tell. For CPF, firstly, there are rules to using your CPF, and there are also some limitations on how much CPF are you going to gain over the course of your working lifetime. So, for example, right here I can show you the CPF allocation rates for employees. Yeah, so it has gone down since back then. During our parents' time or even our grandparents' time, the employee contribution was 25%, the employee contribution was 25%. Today, it has gone down to 20% from employees and 17% from our employer. So technically speaking, our total contribution towards our CPF has gone down. Of course, our incomes have risen over the years, but the apportionment towards retirement has gone down generally across the board. So just so you know, when you're looking at the CPF tables and all that, if you're 35 and below, of the 37% that goes into your CPF, 62.17% of that goes into your ordinary account. 16.21% goes into your special account, and 21.62% goes towards your MediSave account. So now what happens as you grow older, when you are 35 to 45, the 60 in for this case, the most important account with respect to your mortgage would be your OA. your ordinary account, because that's the only account that you can use to purchase your property, or you can use towards paying down your property. From 62%, it goes down to 56.77% when you are 35 years old. So that's like a 6%, 5 to 6% decrease. Although we may want to assume that there's an increase in income when you start off working, let's say at 25, 26, 27 years old, there's an increase in income by the time you're 35. This allocation right here goes down. What does that mean? It means that when you apply for your property, when you are perhaps 28, 29, 30 years old, whatsoever, that allocation, that percentage allocation towards your CPF does not remain steady all throughout your lifetime. Do you know that the maximum that you can contribute from your CPF, from your share, is 20% of 6,000 is 1,002. From your employer is about $1,000. Even if you earn $10,000 a month, that means that only the first $6,000 is used to calculate for your CPF. For example, $1,200 from you, $1,000 from your employer. So that makes it $2,200. So $2,200 is the maximum amount that you can contribute into your CPF every month. So even if you earn $60,000 or even $20,000 a month, only $2,200 goes into your CPF. We know that there's limitation on how much CPF you will have over the course of your working lifetime. From 35 to 45, it's 56.77% going towards your ordinary account, and this goes down further to 51.36% of $6,000 max from age 45 to age 50. Then from age 50 to age 55, it becomes 40.55%, then it becomes 46.16% from 55 to 60. However, do note that the total contribution after you are 55 years old goes down. It means, remember just now there was 20% employee, 17% employer, 17% employer. So it totals up to become 37%. So as you age, by the time you're 55, the total contribution from the employer and the employee goes down. Once you're post 60 years old, the allocation towards ordinary account goes down. What can we learn from here? We can learn that you're supposed to finish off your mortgage as early as possible if you are using your CPF. Because CPF has rules. If you're using your cash exclusively, then of course you can have your own rules. Ever heard of this before, that there's no need for you to pay off your mortgage so soon, because even if you pass away, the mortgage will pay off by itself. There's an insurance for that. My answer to that is that is if you pass away. What if you don't? What if you are disabled for life? Touch wood, of course. Of course, you have your life insurance claims that you can use to pay for your outstanding loan. However, this does not go away from the fact that your mortgage is one of your biggest liability, if not your biggest liability. Yeah, so just so you know that as you grow older, your allocation rates goes down. Yeah. Secondly, you need to anticipate your mortgage. You need to be able to actually know at year 10, at year 15, at year 20, what's your mortgage going to look like? What's your loan balance going to look like? A lot of couples that I've met actually want to reduce the tenure of their loan, meaning to say they want to have a shorter loan repayment in terms of years. So instead of the typical 25 years perhaps for private properties is 30 years, they want to shorten it to about 10 years or 15 years. This increases your monthly payments towards your financier. It can be a HDB loan, it can be a bank loan, whatsoever. However, what happens is that the interest that you should be paying over 25 years goes down, that you pay lesser interest if you choose a shorter tenure. What it also means is that it's going to really strap your cash flow. So it all matters to what you want as a couple. has different effects, different consequences onto your own family's finances. If you do not anticipate that you are going to move homes, um, this will be the only property that you will be staying in for the rest of your life. It's really a good choice to actually pay off the property as soon as possible. You exhaust it as soon as possible, and then after that you can concentrate on rebuilding and compounding that CPF for the purpose of your retirement. However, there's a problem there, that if um, you exhaust all your CPF and a spouse decides to stop working, perhaps to take care of your kids, be it a stay-at-home mom or stay-at-home dad. Or if one decides to become self-employed, or one gets retrenched, and a lot of adjustments have to be done. Of course, you can speak to the one who's giving you a loan. Let's say it's a HDB loan or it's a bank loan. For HDB loan, it's easier for you to go to the HDB office and say that I want to actually extend mine from, let's say, hypothetically speaking, from 10 years to make it to 20 years. You can do that, as long as you make payments. But for the banks, it will be considered like a refinancing, or refinancing in that sense, so that it will incur costs. Before you decide on the tenure, early on, discuss with your spouse whether this is a wise move right from the start. Yeah. So next, we also want to see the price of the property versus your household income. Your household income is so important, as opposed to the price of the property that you want to purchase. Why do I say so? Because a lot of couples buy homes too high as opposed to their income. What am I saying? Uh, as if people are buying properties that are way above what they can afford. For example, if you earn $3,000, both earn $3,000 each, uh, I think you shouldn't be purchasing something more than $500,000. Yeah, but I do understand that couples who earn that amount would like to actually perhaps stay near their parents, uh, or near their siblings, so that in the event in the future that they have children, that they have family around them and it's convenient, or they know the area very well. um, but this again, uh, makes it difficult for the couple to actually make that decision, whether it's a wise decision or not. You need to really look at your finances and really need to look at the possibility of your career, and your income capability. Yeah, because if you do not manage this well, or if you do not anticipate well, I mean, anything can happen in life. Then the property that you are residing in is going to be a burden to you, uh, and that's when people feel forced to sell later in the future, which is also, of course, not so good. Yeah. One, how do you measure yourself? What are the three things that you should be considering, whether that property is suitable for yourself, other than location? I understand that for real estate, we want to buy something that is all about location. However, if that is your primary residence and your only residence, you have other factors to think of as well. Because location, I would, in my opinion, is more for your investment property. Although it would be good if you can have location for your residential property, but not everyone are so lucky. So the first one is, how stable is your job? Your job stability, is it stable? Are you drawing a stable paycheck? What's your job prospects like? How many times have you changed jobs? When I say change jobs, is not moving from companies to companies, meaning to say change jobs in terms of changing industries or still figuring yourself out, or are you quite settled in this job and you want to go for the long term? So that's one. Number two is your own personal philosophy. Um, philosophy goes a lot with financial planning, especially for couples, because people get married. Uh, Usually, their philosophies in life are somewhat similar, or they share some common values. So, your couple philosophy? What's your philosophy when it comes towards buying a house? What does it mean? Because many couples, when they buy a house, they envision their kids running around here. They envision that they can, you know, go to their parents' place. That is equidistant between their parents' place. Um, a lot of all this, and how important their parents are to them, and how often they want to visit their friends, their siblings, their parents, and whatnot. So personal philosophy matters a lot. So you have to discuss this with your partner on what is your philosophy as a couple. Is this home your only home? Will you have another property in the future? Will you sell this property? Will you move somewhere near your parents? If your parents get sick, will they move in with you? Um, how many kids would you like to have? Which brings me to the third point, which is childbirth. How many kids do you expect yourself to have? Do you want kids to begin with? And then a lot of other issues to think about before even spending a huge 6-7 figure sum on a property. Of course, there are many people who view property as purely an investment, and that is fine. There's nothing wrong. What is most important is point number two, which is what's your philosophy? Um, do you see this as an investment or just as a residence? Some people just view this as a residence. They want to buy one more in the future, or they see this as a temporary residence for 5 years. Once they fulfill their minimum occupation period, which is called MOP, they will move on. They will sell this property for a higher price, hopefully, and then move on to a private property, or even upgrade to a bigger flat, or even downgrade to a smaller flat. So it depends on your philosophy, on how you view property as part of your portfolio, as part of your asset. So these are things that you should have. This should be part of your plan as a couple, even before you sign on the dotted line. So these issues revolve around things that you need to consider. Uh, and another thing that you have to consider is on the amount that you can use from your CPF towards paying for your property. If you just Google into CPF and go into CPF website, you can see that there's a thing called valuation limit and also withdrawal limit, especially on resale and private properties and properties that are bought on bank loan. So you have to know this. Feel free to go and look it up on that. I will discuss on valuation limit on the next video. And this is an interesting subject, especially for couples who want to buy resale flats, because perhaps it's nearer to their parents. One, number two, it's some couples have the philosophy that they want a bigger place for their children to run around. Uh, Reason number three is because that resale flat has more amenities around as compared to a newly built BTO. Also, in that video, I will discuss about HDB loan versus bank loans. There's a lot of discussions over the years, but I think nowadays is pretty settled. So thank you for this, and I see you in the next video.